What drives people most to Tesla is its incredible innovations and the uniqueness of its products. This has placed the car company in a position where it is able to pull massive demand for these products. From the Robotaxi to the CyberTruck, and even the Tesla bot, all these have proven that indeed, Tesla is a leader when it comes to driving innovations. So, if you're a fan of Tesla and are looking out for the next big thing for Tesla, then be sure to stay on the lookout for this video, as investment management firm ARK Invest discloses Tesla's $12 trillion opportunity. You definitely don't want to miss out on this one. Hey guys, welcome back to Tesla Tomorrow. According to recent reports, Tesla is looking to build a battery plant in the United States, in what would likely be a controversial arrangement with China's dominant electric vehicle battery manufacturer. The automaker discussed plans involving CATL with the White House and is also considering building the battery plant in Texas to supply its EV assembly plant there. Some experts claim that Tesla wants to pursue a deal similar to the one that was recently announced by Ford, also with the battery maker CATL, to construct a plant that is wholly owned by the US automaker. Like the Ford deal structure, Tesla would own and operate the factory while licensing the technology from CATL. Why does Tesla need a battery factory? And how will this new factory affect Tesla's production? More details to come in this video. But before we start, if you like this type of content, hit that like button, subscribe, and turn on notifications to keep up to date on everything going on with Tesla. Tesla wants to make lower-cost electric vehicles as a key part of its plan to fend off competitors. But to do this, the automaker needs to invest in low-cost, cutting-edge battery tech to see that vision through. A cheaper car would be an effective way to entice new customers to Tesla. Musk himself teased at a Morgan Stanley conference that there's a clear path to a smaller vehicle that is half the production cost of the Model 3, which is already Tesla's cheapest vehicle with a starting price of around $43,000. Elon Musk has the ambition for Tesla to sell 20 million vehicles per year by the end of the decade. However, given Tesla's delivery of roughly 1.3 million vehicles last year, it certainly has a long way to go in order to hit Musk's goal. If Tesla were to really produce 20 million vehicles by 2030, then one important aspect that it needs to focus on is its batteries. If Musk is serious about delivering EVs that everyone can afford, he'll need to get serious on bringing the costs of its batteries down. Failure to do so risks ceding the market to hungry competitors. According to Benchmark Mineral Intelligence CEO Simon Moores, to truly build a sustainable, low-cost EV, a number of cost controls need to be implemented across the supply chain, especially with batteries. Batteries are the rechargeable workhorses of electric vehicles, and they depend on a critical mix of metals, especially lithium. Experts like Moores have said that Tesla's next-generation EV will need to make use of a particular type of lithium known as lithium iron phosphate, a form of the metal that can be used to produce lower-cost, safer batteries. Musk himself said at the Investor Day event that though there's enough lithium in the United States to electrify all of Earth, the limiting factor is transforming the metal into battery-grade materials. Tesla is already starting to take control of its own supply chain. In 2020, Tesla made a multi-year deal with Australian miner Piedmont Lithium, which has a site in North Carolina. The EV maker is also counted as a customer of Albemarle, a lithium miner and producer based in Nevada, as well as Kansas-based Compass Minerals. During its Investor Day, Tesla announced that it has plans to start outputting lithium from a refinery at its gigafactory in Texas later this year. Most established car makers work with suppliers for most of their components, as their supply chain has been created and honed over many years. This was their strength, but also became their weakness when the supply chain disruptions left many in disarray. Tesla, on the other hand, prefers to build most of its components in-house, which explains why the car company seemed almost unaffected by the chip shortages and other supply chain issues. A large number of automakers want to go all electric all at once, and this has created problems in the past few months. Raw minerals and materials like lithium, nickel, and cobalt have become harder to source, which led to surging prices. Right now, every car maker is engaged in a battle to secure a steady supply of minerals needed to build batteries. The cost of materials for electric vehicles more than doubled during the pandemic, forcing automakers like General Motors, Lucid, Rivian, and even Tesla to raise prices of new vehicles. GM raised the prices of GMC Hummer electric pickup truck models by $6,250 in June, citing an increase in commodity and logistics costs. Likewise, Tesla tripled the cost of its performance versions of its best-selling Model Y SUV in 2022. However, Tesla is gradually coming out of the supply chain crisis, as it now is sourcing for most of these raw materials itself. Musk spent a portion of earnings calls last year encouraging listeners to get into lithium refining business. The growing portion of Tesla's LFP vehicles have, in part, been the result of a deal to stick with CATL in 2020. And so this deal may be just what Tesla needs to get a hold on its batteries. With a good supply of batteries, Tesla would have a better chance of actually reaching its 2030 production goal. According to ARK Invest, EVs are expected to scale from about 8.5 million in 2022 to about 60 million units, or roughly 75% of the market during the next 5 years. And the company's CEO, Cathie Wood, has said this estimate could prove conservative. Over the last 2 years, ARK Invest has laid out several price targets for Tesla shares when factoring in robotaxis and full self-driving. The latest model from ARK Invest, which takes out those two feature items, settles on a price target of $500 by the year 2026. Wood has praised Tesla's advantage over rivals and the potential value of a $25,000 vehicle. According to her, it's going to be very difficult for the competition to beat this, and none will be able to come anywhere near it. ARK's 2026 price target for Tesla stock is about $500 per share, based on its EV business alone. According to ARK Invest analysis, Tasha Keeney, this represents additional context to the 2026 pre-split price target of $4,600, which the firm announced in mid-April 2022. Keeney noted that the firm is removing autonomous driving and any form of ride-hail from the valuation framework. She added that ARK believes that these two factors will drive more than 60% of Tesla's value over the next 5 years. Autonomous driving is the next tech frontier and is poised to unlock trillions of dollars of value and be one of the largest societal impacts since the iPhone. Due to the nature of the technology, it is believed that autonomous driving will be a big deal if it is eventually achieved. However, without the right disruptive culture, there's no way to maintain a dominant lead in the autonomous cars. Since autonomous driving is a subscription-based model, cost leadership, electric vehicle efficiency, and safety are paramount to maintain the lead, and the company that has the right culture is set to maintain that lead. This is why Tesla's got an advantage in autonomous driving. The automaker continues to increase car efficiency with innovative solutions. Each of these improvements secure a cost-per-mile advantage, which ultimately results in the most affordable autonomous driving service, and Tesla's improvement culture unlocks this. Tesla also has proprietary data gathered from millions of its cars on the road, billions of miles driven, and all of this comes together to form an amazing package. While there are doubts about the safety of autonomous driving, it is expected to be safer than human driving in the long run. ARK Invest believes that Robotaxi will be huge for Tesla, and upon scaling, these cars will be cheaper and better, which will consequently drive up demand. The dedicated Robotaxi will be highly optimized for autonomy, meaning that it won't have a steering wheel or pedals. According to Elon Musk, there are a number of other innovations around this vehicle that he thinks are quite exciting. Musk said he thinks Robotaxi can be quite a powerful product as Tesla aspires to reach volume production in 2024. He also added that the Robotaxi could be a massive driver of Tesla's growth. The interesting thing is, Tesla's EV business is already huge, and so its success with autonomous driving will only be a plus. According to Cathie Wood, Tesla does not need autonomous ride-hail to be a success, as the EV opportunity alone is enormous. What are your thoughts on Tesla's success with autonomous driving? Let us know in the comments down below. And if you want to know more about what Tesla's been up to over the last few days, go ahead and click on this next video on your screen. See you there.